Hey guys, it's Andrew Henderson from Nomad Capitalist, nomadcapitalist.com. I'm here in Kuala Lumpur and wanted to share with you a little tutorial that I explained to a gentleman named Joseph earlier today when it comes to renouncing U.S. citizenship and how the U.S. exit tax works for folks who do renounce their citizenship. Now, Joseph is a cryptocurrency investor. We did a video recently on cryptocurrency where I said that the big drops recently in cryptocurrency are actually a great time, whether you're in the US or whether you're in some other high tax country that imposes an exit tax for departing residents. Now is a great time to get your affairs in order and dramatically reduce your exit tax when you leave. But for folks who are US citizens who want to renounce US citizenship, there is an issue of will you be subject to an exit tax? And I want to explain how that works because there is a lot of confusion. Essentially, when you're a US citizen, on the day of your expatriation, the U.S. government may impose a mark-to-market exit tax on all of your assets as if you sold them. So you go in, you raise your right hand, you give the oath of renunciation. You're no longer a U.S. citizen for tax and for most purposes. And the day before that, they figure out, all right, what was your net worth? What were your businesses worth? What's your cash worth? What are all of your assets worth, including, in their opinion, cryptocurrencies? That's the law. And there are three ways to trigger the exit tax and become what's called a covered expatriate. The biggest way that a lot of people get stuck with this status is they're not tax compliant in the United States. So there are folks who were born in the United States but never called it home. A lot of folks like this in the Netherlands, Canada, other places where they are U.S. citizens accidentally, and they never knew that they had to file taxes in the U.S. because they never view themselves as American. Well, lo and behold, they do. And they, along with everyone else, needs to be able to certify years of tax compliance before renouncing citizenship. Because if you renounce citizenship and you can't certify that you are in compliance with your income tax obligations for the previous 5 years, then you will become a covered expatriate and you will be subject to an exit tax. The other criteria are, do you have a net worth of $2 million or more? Everything put together, $2 million, assets minus liabilities. Or do you have federal income tax liabilities of approximately $160,000 a year for the previous 5 years? Not federal income tax, not earnings that are subject to tax, but actual federal income tax of about $160,000. And I'm using rough numbers so that year over year we can keep this video. So if you made about, probably about $500,000 on average for the last 5 years, you're probably going to trigger that tax. If you have $2 million or more, you will trigger the tax. If you are not tax compliant, you will trigger the tax. Now, of course, you can't go back and undo your earnings. You can't go back and undo your net worth, although there are some gifting strategies and there are things that people do to reduce their net worth. Some of that could be actually buying the passport that gets you your second passport to be able to renounce. That reduces your net worth. What you can do, obviously, is you can go back and get in tax compliance. And so if you're not in tax compliance and you're thinking of renouncing U.S. citizenship, you need to be tax compliant. And when we talk about cryptocurrency, I would say that would include cryptocurrency stuff too, because the last thing you want them to do is find out something later and come back and nail you. But let's say you can avoid it. You have a high net worth, you've made a lot of money, and you have to pay a U.S. exit tax. You will become a covered expatriate, and you get approximately a $700,000 exemption on your capital gains. So what happens is, again, the day before you are deemed to expatriate, they look at the value of your assets. You will declare those in a form after you've renounced. And, basically everything is deemed sold. If you own a business, the value of that business, you need to sell it. Now there's some certain, there are a lot of things that go into how to value a business. If you're running a business overseas, some of that cash that's in the business may be able to be marked down. There's different things going on when it comes to how to value a business. When it comes to cash, that's pretty easy to value. When it comes to cryptocurrencies, those are actually relatively easy to value. Real estate in the United States and other developed countries is pretty easy to value. Real estate in emerging economies should get a valuation for that, and that may be a bit more difficult to value. But basically everything you own is thrown into the exit tax. And so, you know, if you own a house in London, and you paid £100,000 for it 20 years ago, and now it's worth £500,000, well, if you're a covered expatriate, there's a £400,000 or $500,000 or $600,000 capital gain, and you'll be taxed at long-term capital gains. If you bought something 3 months ago and it's gone up in value, that'll be a short-term capital gain subject to income tax. And so you don't actually have to sell the assets, they just tax you on them regardless. If you trigger that exit tax. So again, if you're going to renounce, you want to be tax compliant, you want to look at, am I single, am I married, what are my gifting strategies, how can I potentially reduce my net worth, is there any way to do it? And then from there, basically figure out, what am I going to owe? I do think for a lot of folks, especially folks with fast-growing businesses, fast-growing investments like in cryptocurrency, it may be better just to pay something, not worry about it as much as you might think, and just be done, and then enjoy the ride up from there. I think some people look at it, if I owe an exit tax, it's not worth it. Well, the exit tax could get worse and worse every year. They could change the rules for the exit tax. They could change any of the conditions for renouncing in the future. And so, paying an exit tax is not the end of the world. But let's be clear. If you have $2 million in assets, or you meet the other criteria, you will trigger the exit tax. From there, you don't get the $2 million for free. The first $2 million is not free. If you trigger it, then the next equation is, what do you pay? And from that, roughly $700,000 in gains are exempt. So you don't get the $2 million and then an extra $700,000 in gains. If you trigger it, you get $700,000 in gains for free. Again, figuring out exactly what your net worth is, what your gains will be, is an issue for much more complicated tax planning. But if you have $2 million in gains, even if you don't sell that house in London, or even if you don't sell the cryptocurrency, even if you don't sell the business, they are going to tax it, perhaps mostly at long-term capital gains rates, a little under 20%, and you will pay that with your final income tax return. So for Joseph and everyone else out there who's trying to figure out how does the exit tax work, that is an introduction. If you want to learn more about these topics, definitely subscribe to our channel here on YouTube. A lot of videos on crypto, a lot of videos on international tax, international lifestyle, the Nomad capitalist lifestyle. Definitely subscribe here on YouTube. And if you want to learn more, and if you want to get some help figuring this stuff out, you can go to nomadcapitalist.com. That's our website.